How's everyone doing? Welcome back to another episode of the Banker Next Door. I'm your host, Dr. Joe Berquist. So today I wanted to talk to everybody about trying to win more commercial relationships by mastering the switching experience. This is a topic that's near and dear to my heart that has kept me awake many a night as a banker trying to think about the switching experience and how can you make that experience easier, less painful, quicker, the whole nine yards. And it gets to be a very complicated thing, as you'll see here in a minute. So we're going to take a look. I saw this article on Bank Director, which prompted me to want to do a video on this. And this article here is titled "The Hidden Bottlenecks in Winning Commercial Relationships. Banks that control the account switching experience will capture primacy, loyalty, and long-term profitability." Now, again, we're just focusing on commercial relationships here, specifically trying to switch. I would say focus on small to medium-sized businesses. Trying to switch those businesses over can be a very challenging thing. I mean, it's not uncommon when you're going through that process. You're trying to switch somebody over, depending on all the things that they have. I mean, that could be a 2-3 month process. If the customer is really working at it, if they're really motivated to switch, it's still going to take them a few months to switch everything over. It's just not an instantaneous process, and thus part of the thing that makes it very difficult. But let's get into this article here for a minute. For decades, banks have competed fiercely on commercial deposits, often emphasizing pricing, digital onboarding, and treasury services as their growth levers. Yet a stubborn bottleneck persists, a longstanding challenge in commercial banking: the complexity of moving a business's primary operating account. Commercial deposits are among the stickiest and most profitable relationships in banking. But ask any director how often prospective clients actually move their primary account, and the answer is usually not often. The reason lies in how switching has traditionally been done. So the primacy problem. So transferring a business operating account has traditionally been an operationally complex and resource-heavy process. Businesses must, and they issue 4 things here. Number 1, redirect payroll and merchant services. Number 2, reroute customer payments. Number 3, notify dozens of accounts payable and accounts receivable vendors. And then number 4, time the closure of legacy accounts. So handled this way, migration could take months. Like I said, that's at a minimum, like a 2 to 3 month process. If the bank is lucky, sometimes it could take 6 months or maybe even as long as a year. What begins as an attractive idea often stalls once businesses recognize the disruption and complexity involved. The result: banks invest heavily in relationship managers and treasury platforms, but primacy remains elusive. The cost of this inertia is significant. The U.S. Small Business Administration reports that there are more than 32 million small and mid-sized businesses in the country. Even if only 10 to 15% switch their primary banking relationship each year, that represents 3 million to 5 million opportunities annually. Yet most institutions capture only a fraction of this market. Why this is imperative for unlocking primacy and growth? Well, primacy is not just an operational milestone, it is a strategic driver of profitability. A McKinsey analysis found that primary commercial banking relationships can generate up to 5 times more revenue than secondary ones. These relationships fuel deposits, cross-sell treasury services, and create durable client loyalty. But primacy only materializes once operating accounts actually move. Until then, bankers hesitate to introduce treasury solutions. The businesses hesitate to deepen the relationship. By treating switching as a strategic growth lever, banks can unlock both deposit stability and downstream revenue opportunities. Lessons for consumer banking. So the consumer side of banking already solved a similar problem. So not long ago, direct deposit switching was a major barrier to account mobility. Automation changed that dynamic, fueling challenger banks' ability to acquire millions of customers rapidly. Commercial banking has lagged behind. Businesses still face the same paper-heavy processes that existed decades ago. This gap represents both a risk and an opportunity. Institutions that modernize switching will capture primacy from those that do not. Now, time out for a second. Time out. This is where a lot of time articles like this completely lose me, okay? Because they act like that, oh, well, the banks are just doing this by choice. We're just doing it because that's just how it's always done, and we're dinosaurs and we just love doing it like that. And that these other companies, these challenger banks, they're just so tech savvy and so with it that they just figured it out and they're just on the initiative. Well, no, it's nowhere near that simple. Okay. Banks have a ridiculous amount of regulation that they have to comply with. I mean, they like I said, we have AML, we have BSA, we have CIP, KYC, EDD. Like it's an endless myriad of things that create all this paperwork. And if you do not do this paperwork, you get in big time trouble with your regulators and your auditors for not doing this stuff. Okay. So again, you have to do this stuff. It's required. You can't just wake up one day and say, oh yeah, we don't feel like doing that no more. So I have to put that caveat out there and explain that. So, okay, now let's move on to the technology imperative. So for too long, banks have approached commercial account switching with the same manual methods that defined the process decades ago. Relationship managers often juggle spreadsheets, vendor lists, and phone calls in hopes of piecing together a migration plan. But in today's environment, clinging to these outdated tools virtually guarantees outdated results. Commercial banking is operation in a modern tech era. Businesses expect their financial partners to mirror the seamless digital-first experiences they encounter in every other aspect of commerce. If the bank's switching process is still paper-heavy and error-prone, clients will notice, and competitors that can deliver speed and simplification will win those relationships. Executive management should recognize that leveraging technology is not optional. It is the path to growth and primacy. Advanced platforms can capture, organize, and automate the many dependencies tied to a business operating account: payroll, payments, AR, AP, and more. The payoff is more than efficiency. It accelerates time to funding, empowers relationship managers to deepen conversations earlier, and ensures the bank doesn't lose momentum at the most critical moment in the relationship life cycle. And then he finishes off with a call to action. Commercial account switching is not just a back office process, it is the gateway to deeper commercial relationships and a missed opportunity if neglected. By institutionalizing a switching playbook with clear workflows, accountability, and banker enablements, banks can, and he lists out 4 things here: increase the win rate of competitive takeaways, compress time to funding for new accounts, unlock earlier cross-sell into treasury and payments, and 4, improve banker productivity without adding headcount. So for banks, the message is clear. Switching deserves a place on the strategic agenda. The institutions that control the switching experience will not just capture deposits, they will capture primacy, loyalty, and long-term profitability. So, and again, I love it. I really do. I love the call to action at the end. I think he is spot on. You know, the banks that can really dig into the switching experience and try to even if you can make it just somewhat more palatable, that's going to give you a major advantage over your competitors. Again, I don't think you need to make a quantum leap in, like, jumping into some amazing program. I think if you make incremental adjustments, so in other words, another bank, every other bank out there is going to take them 3 months to switch that customer over. If you can decrease that to 2 months, if you could decrease it to 1 month, again, you're going to be ahead of the curve. The challenge comes in all those things that we talked about at the beginning, because again, it's not just the bank. It's looking at, redirecting payroll, merchant services, rerouting customer payments. And then you can't forget about so many customers today have so many ACHs set up. You got to, switching all that over takes time, and it's a massive headache. And the bank, we can't really help with a lot of that stuff because the other thing is, like, the customer, do they really want us to? And then, because again, what if we mess something up? What if we get into things? It could get very messy real quick. Notify dozens of accounts payable and accounts receivable vendors, and then the closure of legacy accounts. So yes, I mean, it takes time, but again, you also can't miss the point that banks want it this way. I mean, banks want it to be difficult to change over because that's what keeps customers there. If it was easy, you'd be gaining and losing customers all the time. I mean, it'd be all the time. Yeah, you'd gain a lot of customers, you'd lose a lot of customers too. If it was that, if the day ever comes that it becomes that easy to switch banks that, the bank does one little thing and somebody's out the door. A lot of banks are going to have problems. Because you could take customers in more quickly. You can also lose those customers a lot more quickly. So, but this is absolutely one of those critical issues in commercial banking. Again, your banks are always after it, again, community banking is all based around relationships, building that relationship with the customer, and then, the more deposits, if you could get their primary accounts, their main operating accounts, their payroll accounts, if you can get all that, then you can cross-sell them all those other goodies. You could cross-sell them the positive pays and all the treasury management services, the lock boxes, all the different, say, merchant services, all the different things that go along with that. And thus making it a much stickier relationship. Then undoubtedly you could try to cross-sell loans, lines of credits, equipment loans, term loans, whatever they need. So again, it all flows in there through that. And what lies at the heart of that is that deposit relationship and being able to bring that over. So again, very, very, very interesting topic. Like I said, near and dear to my heart here, because I can't tell you how many months and years I've spent racking my brain on this one, trying to figure this one out and seeing a way that banks can make this a better process. So if you have any ideas, any comments, leave them in the comment section down below. I'd love it. So, but with that being said, I'll wrap up by saying, if you like this episode, please make sure to like, share, and subscribe, as that always helps the channel. Remember, we are on Rumble, YouTube, and all major podcast platforms. Please be sure to leave your comments down below. And as always, make sure to check out some of the other content on the channel. I thank you so much for listening. I hope you have a great day out there, and I will see everyone again real soon.